Ladies and gentlemen, Greg McCloskey from ForexLive.com. I'm going to take a Forex quick look at the dollar versus Canada. In 2023, we've seen a lot of ups and downs in this currency pair, and we're heading into the last trading month of the year, and also near some neutral levels as a result of the ups and downs seen and the most recent move to the downside. So let's take a look at that currency pair from a technical perspective. Looking at 2023, the high price came in at 138.98. That was in the beginning of November. The low price was around mid-year, and that came in at the 139.18 level. That was in the month of July here. And so July low, we had November high. We also had a high price going back here, which is the month of March. So there was lots of downs and then ups, and now we're moving back to the downside. And the move to the downside that we've seen over the last few weeks of trading has taken the price back below the 100-day moving average. That's a blue line in the chart, and trading last week came down to that level, tried to bounce off of that level, but then failed and fell lower on Friday's trade. We also have the 200-day moving average that comes in at 135.16. So the 100 at 135.50 or 65 and 135.16, where those two moving averages are. In addition to that, the 50% midpoint of the trading range for the trading year comes in at 134.95, and you can see on Friday and again today the price did break below that 50%. So the sellers had their shot on the breaks of both the 200-day moving average and the 50% retracement. And as you can see, the current price is trading at 135.36. So we are in between these two moving averages, and that is a neutral level. But by definition, below the 100-day moving average is more bearish, above the 200-day moving average is more bullish. So those cancel each other out. We're more neutral. And that may be apropos for the ups and downs that we've seen in 2023 for this currency pair as it followed things like oil prices and the economies in both the U.S. and Canada. So what would be needed to increase the bearish bias? Well, to increase the bearish bias, we need to get back below the 200-day moving average of 135.16-ish area, and then get back below the 50% retracement. If we're able to do that, I would think that we'd after two fails, that we'd see further momentum with a move down toward the 134 level, which is a 61.8% retracement. That it would be my thinking of the most likely move from a technical perspective. Conversely, if we see the dollar bid move into this currency pair, and we move back above the 100-day moving average and 38.2% retracement, I would look toward this swing area right through here between the 136.41 and 136.67 to be the next key target on the top side. So, first things first, we need to get outside the 100 and 200-day moving averages, and then the next steps would be to get below the 50% retracement or above the 38.2, and then we look for the next targets in this currency pair, whether it be the 61.8 on the downside, near the 134 level, or the swing area up on the top side between 136.41 and 67. Those would be the progressions. But right now, things are more neutral in the dollar versus Canada as it looks to complete the yield year in what has been a up and down trading range for this currency pair. My name is Greg McCloskey. Good fortune with your trading. Bye-bye now.